Good morning, good afternoon. Hello, everyone, Global Alliance family. I hope that you are all stepping into this Christmas season with full hearts and big dreams and that signature gap energy that keeps elevating us all together. As we are nearing to closing out the year, this is the perfect time to reflect, not just on what we've accomplished so far, but on the legacy that we are building. Um, and there's no better gift that you can give yourself, your family, and your business than positioning yourself with the assets that grow and protect and multiply your wealth. So that's why today's session is on DSCR loans and so timely. While most people are slowing down for the holidays, investors who understand this strategy are quietly setting themselves up for a powerful 2026. So this is the season to plant seeds, and real estate is one of the smartest seeds that you can plant. So we're thrilled to welcome Joseph Castaneda. He is the CEO of Duke Allen and Company. And we had him here before, so we were excited to invite him back and help us break down the DSCR loans, how they work and why they matter, and how they can open doors to new income and new opportunities and long-term stability. So it's the gift that keeps on giving. So you're in the right room with the right community at exactly the right time. So let's dive in and elevate together. Welcome, Joseph. How are you?
Rebecca, happy Monday. How's everything? It's been a while.
I know. It's been a while. We're excited to have you back. Welcome, my friend. Take it away.
Thank you, thank you, thank you. Well, guys, like Rebecca said, guys, we are ready to kind of finish out the holidays. We're still running a business and we have to take that very serious, especially going into 2026. And so you want to have some sort of a GPS, a map as to how you could cater to your clients, diversify your income, because many of you are focused on the traditional side as a realtor, but there's also a huge market on the investment side. And there are a lot more investors coming into 2026, even though the market might seem a little uncertain, but many people go into a new year, every new year, with an expectation, a higher expectation, right? They have their New Year's resolution as to saying, hey, you know what? Next year, I want to invest. I want to start looking at fix and flips. I want to start looking into maybe doing short-term rentals, with VRBO or Airbnb, right? And so what happens is, as you start sharpening your skill set, people are going to start gravitating towards you because you are that professional in real estate. Crazy thing, I mean, you guys already know this, right? But if I'm not an investor, if I don't know nothing about real estate, but I know Rebecca, I hold Rebecca and Josh at a high pedestal because I'm assuming they know everything. They know a plumber, they know a lender, they know an inspector, they could find properties. And it's the same thing applies to you, the agent or a realtor, right? So what happens is when you start promoting your business, your services on social media, people think you're a gamut of tools, right? A gamut of resources. And you want to be ready to when somebody comes to you and says, let me pick somebody here. Didi from New Jersey, right? Hey, Didi, how are you? I go to Didi and I go, Didi, hey, you know what? Next year, I want to buy my first Airbnb because I travel a lot. I travel to Orlando. I travel to Dallas. I travel to Atlanta. And I seem like I'm spending a lot of money on Airbnbs or like accommodations for housing, right? And so I go to Didi. Didi, help me find something in your market. And Didi's gonna be like, okay, yeah, sure. Now she's scrambling around as to how I could move these important pieces for my client. But guess what? Because you're part of this community, now you're going to have access to resources. One of those resources is money, fast money. And when I mean fast money, it's non institutional money. Okay. And so what happens is you want to be ready for this going into the new year, promoting your services as a realtor or an agent. In certain states, it's different, right? An agent and realtor. I'm not an agent or realtor, so I don't know what's the difference, but you get what I'm trying to say, right? So the cool thing in today's training we're going to be going over is DSCR loans, which stands for debt service cover ratio. Okay. And it's very important that you guys just know just a tad bit of what this program does and brings value to your client. You don't need to know everything. You don't need to know every intricate detail of a loan because in your world, it's not part of you understanding the true underwriting of it. But today I'm going to go through it. I'm going to give you a quick overview as to how these loans work, what kind of documents we need, because it's fairly simple. It's not like a full document loan with your traditional lender, or you going to Bank of America and having to have a whole scroll of list of items that you need. Guys, we make it as simple as possible. But as long as you know the basics, you'll be so resourceful. You'll be a very important piece to your investors' playbook. And not only that, understand this: an investor right now, averaging in 2025, is doing anywhere between 2 to 4 deals a year, 2 to 4 deals a year with that same agent. Because once, for instance, let's say you get him a fix and flip project. You're finding them the property, and guess who's selling it on the back end? You are. So you're eating twice off of that one borrower or a client, and they're doing 4 of these a year. Guys, like you guys could make a killing just on the investment side, right? Now, nothing is easy. I'm not trying to say it's easy, but it's simple when you have pieces in place so you could bring a whole plethora of options to your clients and say, hey, listen, this is what I got for you. This is the person that you need to talk to for financing. This is a person you need to talk for as far as title. I'm pretty sure you have a title company or an attorney that you work closely with in your market, right? So if that's something less that your client has to do, let me tell you, you're up there. You're up there as a very important piece to their puzzle. I'm gonna go ahead and share my screen here, and we're gonna be going um over what our programs cover. Okay. Can you guys see my screen? Yeah. Okay. Well, beforehand, my name is Joe Castaneda. I'm the managing partner of Duke Allen and Company. We're a private lending firm here in Atlanta, Georgia, and we've been in the industry since 2005. Okay, I used to originate back in the mid 2000s for Countrywide, so I was part of that whole roller coaster ride all the way up until 2008 when everything just kind of crashed, right? So we were based out of Aventura, Florida. I'm originally from New York, raised in Miami. We currently live in Atlanta, Georgia. And we're also real estate developers. So the cool thing with working with us guys is that we talk to you and your clients with two sets of voices. One is as an investor, like we could relate with other investors and their challenges and how they bleed money every day and it's not fair for them because you know what? We're investors as well, right? We're the last ones to eat. So when you understand how an investor thinks, your life just becomes that much easier. And second, we're underwriter. We'll let your client know, hey, listen, they're overpaying for a property. Maybe they might be missing something from their budget, or what to look for when it comes to Airbnbs and VRBOs, short-term rentals, or long-term rental projects. Okay. So what is a DSCR loan? Okay. A DSCR loan is a type of financing used to assess a borrower's ability to service debt based off the income generated by an investment property. It focuses on the property's rental cash flow rather than the borrower's personal income. So listen to that closely. I could care less. You could have been fired yesterday. You could have retired yesterday. You could have been, let's say you're an army vet. You might have just done your 4 years and now you don't have some sort of monthly or yearly income. What we look at is that the asset, this is a mouse, but this mouse is worth $250,000 because every time I click this button, it generates a rent every month. I click this button once a month and it generates money. Did Rebecca have to clock in to get this money? Did Rebecca have to put in 8 hours a day, 40 hours a week? No. What she needed to do was move in a strategic way as an investor and put in a tenant that's going to pay her debt for her. So people are like, huh, nobody's put it that way to me. He goes, yes. Any investor that buys a rental, their tenant pays their debt for them. What is their debt? And their debt, we're gonna go into the next slide. But now, we use these type of loans to purchase a house, anywhere from 1 to 4 units. So it could be a single family, a duplex, a triplex, or a quadplex. Okay. These rates right now start off at 6.75. Now, that's very aggressive for being an investment loan. This is under an LLC. Okay. So, like right now, Rebecca, what are you seeing in the market as far as your interest rates with your local MLO?
The interest rates right now,
Yeah.
I haven't even checked them today this morning, sorry.
No, just an average. What are you seeing out there when you talk to your team?
I mean, they're in the sixes right now, right?
There you go, sixes, right? Right now, we're in the sixes as well, and we're an investment loan, guys. We are crazy competitive. And I'll be honest with you, 675 is on the higher end. And I just got to update this number, but we just did an actual soft term sheet at 5.99% on an Airbnb loan. Guys, Airbnb is still hot. There's housing, there's hospitality, right? So when we originate these loans, we're charging a total of 2 to 4 origination points. Okay. We have options of a 5-1 arm, 7-1 arm, and 10-1 arms. These arms are not like back in the mid 2000s that there was a balloon after the fifth year, after the seventh or 10th year. No, we're not going to repeat that same cycle that happened in the mid 2000s. Okay. Has anybody seen The Big Short? I need some hands. I need some
Hi.
who's seen The Big Short?
Josue has seen The Big Short.
Yeah.
Dude, I've seen
So
that
that's what
movie
happened
like
with the
15 times.
Oh my God, tell me you don't you love it. Every time I fly Delta, I have the opportunity of watching The Big Short, I'm on it. Because I lived it. And many of you probably lived it as well if you were in the real estate industry, right? And so what happens is these arms, people were being defaulted on arms, and when it got caught up, for sure they were not going to make those payments, and it was a balloon payment. And so people were just like, oh, I literally, let me tell you, I had taxi cab drivers in Miami Beach owning anywhere between 2 to 4 condos because all you needed was a pulse and you were automatically approved for these loans left and right. It was crazy. It was nuts. I'm like, hey, if the banks are approving this, like they say yes and it's approved, it's underwritten, we got a CTC, we're closing, right? But the difference right now with our adjustable rate mortgages is that let's say it's adjustable it's fixed for the first 5 years and then it adjusts. It will adjust for the next 25 years. So it's no balloon payment. It's just amortized to 30 years. Okay. So that way you have an understanding on how these arms work. This is not a balloon payment of 7 years or 10 years. No, it's a fixed it's a fixed interest rate for X amount of years, and then it adjusts for the rest of the loan terms. Okay. Hold on, let me see what happened here. I kind of lost my. All right. Oh, where'd it go? All right. All of our loans are 30-year fixed. So you don't have to worry about this whole cycle, like, oh my God, what am I gonna do if I get an adjustable rate mortgage at 7 years? And then after 7 years, do I have to sell it or refinance? No, it will just adjust to whatever par is at the current moment. Our minimum loan amount is 660. Okay. 660 is our minimum loan amount. We could go down at 640, but then at that point, terms don't even make sense anymore. To where normally you could do up to 80% loan to value, meaning 20% down to you or your client. Now it just starts dropping. So instead of being 80%, that might be 70%. And if we put up 70 and you or your client puts 30% down, imagine 30% down on a $500,000 house. That's $150,000. And now it just gets away from your client's expectation. And then at that point, it just doesn't make any sense. Understand this. Not every deal is a good deal, and not all money is good money. Okay. You do have to have a social security number. You have to have a credit history to apply and qualify. The beauty of all of this, guys, is that we can make opportunities work. What does this mean? There is something called sponsorships. Okay. Sponsorships. Let's just say my parents are Colombian. Let's say I was born in Queens, New York, but let's just say I was born in Colombia. I'm very good friends with Didi, and I'm going to continue with Didi because we're from up top, right? So me and Didi, we create this great friendship. We understand how it works, and I have the down payment, but my my immigration status is not up to par, right? And I go to Didi. How about we form a partnership? Let's create an LLC. You bring your credit history, you bring your social, I bring the money, and we form an LLC. And on the operating agreement, we would be 50-50. You brought something to the table, I brought something to the table. Now we're creating an opportunity. Will this fly during our underwriting process? The answer is absolutely 100% yes. So we can make things happen. Now, let's just say we needed a down payment of $175,000. I only had 150. Well, guess what? If Didi has 100 grand, now we have $250,000 of buying power to get into opportunities. And this is not just only for DSCR loans, but this also goes for fix and flip loans and new construction. There is no bank that's going to tell you, no, you cannot go into business with somebody. Like we're grown folks. Who's going to tell me how to do business, right? Not even my mom's going to tell me, no, mijo, you can't do this, you can't do that. No, we're grown adults. Like if me and Didi come into an agreement on paper, like nobody's holding a gun to her head or mine and say, you we have to do. No, we've come to an agreement that, hey, if we both win, we both make money. If we both lose, then we take a hit. Every business venture has a risk. It's a good one and a bad one. The good thing about our risk factor is very minimal. Why? Because if the appraisal comes back lower than expected, then the deal doesn't make sense. Is that fair to say? Right. So if the appraisal comes back and the appraisal didn't hit that mark, then hey, everybody gets back their money, your earnest money, because you had due diligence to do your appraisal based off the appraisal contingency. Get your money back, and we keep it moving. Right. So many people, especially now in our Hispanic market, they're like, oh well, ah, I got a work permit, but I got money. I know how to make money, but I just can't qualify for certain programs. Well, guess what? We could make and move pieces around because on paper, if Didi and I go to Chase with your articles of organization, which states that you're in compliance in that state, right? Your operating agreement, which states Didi and I are partnerships, and it states 50-50 or percentages. Let's say it's Didi, Josh, and Rebecca and I, we're 25% owner of this pie, then all four names are going to be on there. So we walk into Chase and say, hey, we're four of us. Here's our information. We want to open up a bank account. Like nobody can tell us that we could be partners or not. Does that make sense? So the cool thing with our hard money DSCR loans is we could be creative with how we underwrite the deals. Always keep this in mind. This is always a legal transaction. There's nothing fraudulent about me and Didi doing business. No. If me and Didi are doing business to make a deal work, then that's perfectly fine. As long as we're both consent, both parties are agreeing to whatever terms we come up between us, then that's perfectly fine. Okay. So the same thing, like even like reserves. If let's say I went today to Rebecca and I'm like, Rebecca, I want to buy this house in Kissimmee. She showed me the house. I love it. Great. I go to a hard money lender and I say, hey, listen, I want to buy this house. And they're like, well, Joe, you're going to need $150,000 and a credit score of 660. And I'm like, oh, well, I know I don't have the credit. I literally could go in the next 5 minutes and talk to Didi and say, hey, Didi, have an opportunity. I have this property that makes sense. All the numbers are there. I have this money. How about we team up and we become partners? Didi, of course, is going to ask me certain questions to make sure that it fits her criteria. If she says yes, literally, I could add her or create a new entity, and now we become partners. We go into Chase, we open up a business account, everything is there, everything's written down on paper, it's a legit transaction. Once we get those documents, we submit it to our underwriters, and they go ahead and move forward with the transaction. So, guys, it's about creating the opportunity. It's all about being resourceful in this industry, and you guys know this 1,000%. Okay. Now, outside of that, like I said, we will finance a single family home up to 4 doors. Okay. On purchases, we could lend up to 80% of the value. That means we put up 80, Didi and her partner will put 20%. Okay. Now it says up to. Always keep this in mind. Say always the keyword is up to. It's not saying we will, because nobody guarantees something on paper without doing their due diligence, right? Good. When we're doing a cash out refinance, we'll refinance up to 75% of the as is value. Okay. The property has to be move-in ready. These are non-owner occupied loans, which means the borrower, Didi or I, cannot live in this property. Okay. Because then that's mortgage fraud. When we get to the closing table, there's a document that states non-owner occupied loan. And it's going to clearly state the borrower is not to live on site. If it does and they find out, it's mortgage fraud, and nobody wants to get in trouble. We have to make sure that this is a truly an investment property. Okay. Um, the property must be move-in ready. And of course, we always love to try to finagle our way in. Guys, listen, an appraisal tells a story. An appraiser's gonna go in there, take actual pictures of the subject property, and you could tell literally, can you live in it? Can your mom live in it? Right? Oh, well, no, I just got to do some touch up paint here, remove cabinets, do a bathroom, but it's nothing big. It is big. A DSCR loan is a move-in ready loan. If it's not move-in ready, the appraiser submits that report to our underwriters, and our underwriters are going to clearly say, hey, the flooring is horrible. There seems like there's mold around the house. The kitchen cabinets, the doors are just hanging off the hinges. No, this is not move-in ready. Okay. Anything that needs a renovation would need a fix and flip loan, which is a hard money loan. Okay. Prepayment penalty. These are all 30-year loans. The banks are they're counting on this money to be paid within 30 years, 360 months. If you pay this back within the first 5 years, there is a prepayment penalty, okay? Because they're setting this money aside so they could bank on that money, say, hey, you know what? If I put this money in this one asset for 30 years, I'm gonna make X amount of money and I don't have to worry about that money forever, pretty much. But if you pay it back before that, then yeah, expect a prepayment penalty. Setting up the expectation for a DSCR loan is huge. Okay. Why? The person selling this property always is in somewhat rush. Oh, it's the seller is how do you say it? what's that magical word? Oh, every person puts down is
Distressed, distressed.
distressed. That's one. Motivated. There we go. Motivated. Of course they're motivated. They want to sell, right? And so when it comes to a fix and flip loan, we typically could close within 7 to 10 days because it's quick. We understand it needs renovations. But when it because that loan process is a lot easier. Think of this as a marriage. Like you just don't meet a person and all of a sudden you're meeting them at the altar, right? The very next day. No, you need to get to know them, you date them, then you meet their parents, and you meet the family, and it's a process, right? Because you need to make sure that this whole package, the package is the borrower and the asset, makes sense for the lender. And so they're going to want to do a background check. They want to do a hard inquiry. This is a hard inquiry loan. You will get hit on a hard inquiry. On a fix and flip, it's not because it's a short term 6 to 12 months. This is a 30-year loan, so therefore it will be a hard inquiry, but listen clearly, it won't show up on the borrower's credit report. So as soon as it closes, if they go in and maybe apply for a primary home afterwards, that loan is not going to show up nowhere near in their history. It'll show up as an inquiry, but not that there is an actual line of credit or a loan against that borrower. Um, 30 days is 21 business days, give or take. So set the expectation from the beginning that any of your clients that need a DSCR loan is probably going to take about 30 days for them to close. Now, why? We have to do our due diligence on the borrower. We have to do an appraisal. We have to run title. Sometimes on that title, we have to get a survey done. And just a survey nowadays takes a couple of weeks. And then we have to assign a landlord insurance policy for it as well. All of our loans are going to be established in an entity in that state. So if it's Florida, then the entity has to be a Florida established entity. If it's in Georgia, then Georgia. If it's Texas, then Texas. Okay. So we're going to ask for your articles of organization, operating agreement, and your EIN letter from IRS, which is for tax purposes. Okay. Your EIN number is different than your Duns and Bradstreet number. Does not know where your Duns and Bradstreet number is? You could raise your hand and I'll explain it to you. Anybody? Okay, actually, you know what? Let me see these chats here. Joint venture. Guys, I'm gonna answer all the questions towards the end of their presentation. Okay. Uh, Angelina. Okay, Jaramillo. Okay. So your Duns and Bradstreet is pretty much your business social. So if you guys I'm gonna write it down here. Go to dnb.com, okay? And get your free Duns and Bradstreet number there connected to your entity. So like your Duns number is like if you want to go get a vehicle to offset it on your taxes, you're gonna go and get your Duns and Bradstreet number, and you're gonna go to the actual dealership and get a loan under your business entity through your Duns and Bradstreet number, your Duns number. Okay, so that's gonna be another conversation for another day, Rebecca, because it gets juicy when it comes to leveraging your business credit for your business, especially for your realtors. You have to be on top of that. But anywho, so your EIN is for your tax purposes. Okay, that's how you're gonna tell when you buy or sell a property. Uncle Sam was gonna want their percentage to be taken off capital gains. So that's pretty much where your EIN number comes into place. Okay, we're gonna ask for 2 months of bank statements of your personal and business. Many of you guys are gonna want to come into clients that just opened up their business account. So they're not going to have any type of history. So submit all your personal bank statements. That will be perfectly fine as well. And it has to be all pages of the summary. Now, we work with a lot of our Hispanic brothers and sisters, right? and they'll take pictures of certain documents and might snip out the corners of the paper. And so if they're gonna snap any pictures, it has to be the whole picture of the page. Like you cannot cut out any corners. Okay. Down payment is typically 20% down. We will require an appraisal. That is mandatory. The reason why we have to order an appraisal and it has to come from the lender himself is because these lenders borrow money from other banks, and these lenders sell this note to a secondary market. And in order to sell this note to a secondary market, whether it's the Wall Street boys or the Beach Boys, I call it the Silicon Valley boys, is because these lenders they don't keep this money on their books. They flip money. And they what they do is when they sell it on the secondary market, they charge fees for selling it. And then when they sell it back to us, they charge more fees. So banks not only make money on interest rate, but fees that they charge over and over and over again. Okay. The lease agreement or market rent. This is very important. Very important. Okay. Because your tenant pays your debt. Your tenant pays your PITIA. And when I say A is your association fees. I know in Florida, HOAs are just ridiculously high. And not only that, but taxes and insurance as well. So what happens is your rent is going to pay your debt. So let's say Rebecca, I loaned her $100,000. Her monthly payments is let's say 850. Okay. She puts a tenant in there for 1,200 bucks a month. Well, good, because those 1,200 bucks is to pay me, and then she keeps the difference, which is called her cash flow. But guess what? Rebecca puts instead of renting it, she puts it on Airbnb. And Airbnb, I've had many Airbnbs in my past in my portfolio. They're very, I mean, they pay very well. You could make 2 to 3 times the rent on short-term rentals, whether you do it through VRBO, Marriott. You could do self-direct, like self-booking, like direct booking. So there's a lot of profits when you're doing it on a short-term rental uh, platform or strategy than just renting it out to the average family or Section 8 or so forth, right? So let's say she's getting about 1,800 bucks on Airbnb. Well, that's phenomenal because she only pays me, the lender, 850 a month. Like Rebecca doesn't have to go punch in. She doesn't have a boss. She doesn't have to do 40 hours of physical labor or having to, you know what I'm trying to say? Your tenant or the services you provide as far as housing pays your debt. The beauty of this, guys, is that we don't verify personal tax returns or business tax returns. We don't verify income. We don't verify employment, and we don't verify what is that called? Transcripts from IRS. Okay, so it's strictly based off 3 factors. We look at the as is value. The value has to be there, or else we're not going to lend no money against the asset. 2, your rent. Your rent has to take care of your debt. And number 3 is your credit score of a 660. Those are the 3 major components of a DSCR loan. Without those 3, nothing else matters. Okay. Um, Property taxes and insurance is part of your overhead. So you have your principal, your interest, your taxes, your insurance, and if you have HOA, then your HOA is going to be part of your overhead. And guys, don't forget, if you have a property management company in place, that also is part of your overhead. So it's gonna hit you if you have a property manager in place because that's part of your overhead. Okay. Now, this is our calculator for your DSCR loan. So remember, we're going to be talking about principal, interest, taxes, insurance, and association, dude. We're gonna take a rent. Okay. Let's see. Didi, are you there? All right. Ready? We're gonna do some homework here.
Yes, I'm here. Hi.
All right. Hey, how are you?
That's good. How are you,
All right.
Joseph? Let's go.
Let's go. She's ready. I love it. I love it. Okay. So let's go ahead and Didi, in your market, what's your average rent for, let's say, a 3-2?
A 3-2 would be about in the luxury market about $5,400.
Cha-cha. Jeez. All
Mm-hmm.
right, 5,400. Okay, let's go.
Yeah.
So you're gonna go ahead and put 5,400, right?
Yes.
All right, I'm gonna put this here. 5,400. Okay. Let's just say, which market are you in?
I'm in Jersey City, New
Jersey
Jersey.
City. Okay, good. Let's just
Mm-hmm.
say she's with her client and we find a property and her PITIA, everything is $4,900. Okay. So you're thinking like, oh my God, this is awesome because, you
Mm-hmm.
know, I'm making $500 cash flow, right? After everything is said and done, whatever's left over is 500 bucks. So you're going to go ahead and put 5,400. You're going to smash the divide sign and then put 4,900 equals what?
Okay. I got 1.102. Does that make
Good.
sense?
Good. Look at the screen here. Our minimum ratio is 1.2.
Ah,
Ah. So it's not meeting
mm,
that requirement.
no.
So there's a problem. There's a problem. Why is because there's many factors. Let's say you're cash flowing $500. To many, it means like, oh my God, that's pretty good. But look at your risk factor. Look at your risk factor. You're risking $4,900 just to make 500. And let's just say in 2 years the AC goes out. What now? All those years and months that you had to babysit, tenants and toilets, 3 o'clock in the morning phone call, this, that, and the fourth. Hey, there's a leak. There's no air. It's hot. Eso y lo otro, right? But now the AC went out and it's costing you about 8,500 bucks to replace it. And you're like, man, this is not fair, right? So now, how can we get this number to reach 1.2? Okay. Let's say this loan was for $1 million. Okay. With these same numbers, I can't let you borrow $1 million because it hasn't reached that 1.2% ratio. So instead of letting you borrow a million, I'm going to have to lower that until that 1.1 reaches 1.2. So it does this until we meet kind of in the medium. So if the loan amount was for $1 million and your ratio was 1.1, let's say 1.1 is really $950,000. That means you would have to bring the additional $50,000 to balance out that number. Yes, that's how that works. Okay. Now, let's flip it the other way around. Let's say, Didi, you have a property, it's worth $1 million. We're doing a cash
Okay.
out refinance. And when we refinance, we could refinance up to 75%. Okay. So what's 75% of $1 million?
750. 750 grand.
750.
Mm,
750
mm.
grand. Good. Your tenant is your best friend from high school, Rebecca. And Rebecca, you're doing her a solid. That's my homie, it's my girl. Man, what? My family knows hers. But I'm letting her stay in this beautiful home for $2,500. Right, because she's your home girl. You're hooking her up. She's like a sister, right? Can the $2,500 pay a note of a $750,000 mortgage? No, right. So I'm gonna tell you. So in your mind, you're thinking, "Oh my God, I'm gonna be able to refinance $750,000." I'm like, Didi, yes, but now let's look at your rents that you're collecting. You're 750 and your rent is here. And I'm gonna say, Didi, I would love to let you borrow $750,000, but you're only collecting 250. You guys want to know how to do the math on how much I could let you borrow based off 250,000, 200, 2,050, $2,500 rent? Take your calculator,
All right.
put 2,500, divide by 1.2%, because that's our ratio. Divide by 1.2 and smash the percentage sign equals. 2,500 divided by 1.2%. Did everybody get that? 2,500. Okay, so you're gonna put let's restart it again. 2,500 because she's renting it out to Rebecca for 2,500. Press the divide sign, then put 1.2 the percent sign and then equals. You got it? What do you got, Didi?
I got a different number. I got 173, 611.
Because you
I
multiply,
got,
this divide.
maybe that's right. Okay.
Yeah. So you're gonna put 2,500, which is your rent. You're gonna smash the divide sign. You're gonna put 1.2%. You got to put the percent sign, right? And then equals.
I still get 173, 611. Is it 1.2 or 1.02?
No, no, no. Listen, listen, listen,
I'm
listen,
listening.
Linda, listen. 2,500, just exactly, word for word, number for number. Divide. And don't be
Yeah.
creative with because in high school they told me 0.1.2. No, exactly the
Yeah.
same way I'm telling you. 1.2, put the percent sign. You have to smash the percent sign equals.
1.2, not 1.02.
Who said oh 02? ¿Quién dijo oh 02? ¿Quién
Yo no sé,
dijo?
pero alguien lo
Nobody.
dijo. Alguien lo
No,
dijo.
pero nada. It's 1.2. So did you get this number?
Yes. Now I got it.
Okay, good. Good.
Now I got
So
it. Thank you.
remember, good. I could only let you borrow $208,000
Oh,
because your rent of 2,500 is enough to pay this. And that's it. I'm assuming that taxes and insurance didn't skyrocket. So that same scenario, guys, where Didi has a property of $1 million. I could refinance 75%, but she's letting Rebecca rent for 2,500 bucks.
yeah.
Now, let's say she didn't know Rebecca and this area is nice. Let's say she was collecting $9,000 from Rebecca. So let's do the same math. Put 9,000, right? Press divide. Press 1.2. The percent sign equals. Rebecca, what you got?
Same as you, 750.
Right. Now I could let you borrow $750,000 because that rent is enough to pay that debt. So that's the
That makes a
unique thing
lot of
about
sense.
total sense because I
Yeah.
could care less how much you make a month, how much you make a week, what's your hourly, what's your salary. I could care less because I'm not going to ask you that. I'm gonna ask you, hey, what's your credit score? What do you think the value of the property is? And how much you're collecting from your tenant? Or if you're doing Airbnb, there's a platform called AirDNA.co, and it gives us like a rental market analysis, right? That way we could have a pulse as to where you could be in this property. Is the property going to make sense? Not every deal is a good deal. Not all money is good money, right? So we all want to be resourceful as realtors, and because you guys are like the kings and queens of real estate. If you're not in the real estate space and you're looking for a plumber, I know Diddy knows one. Un jardinero, somebody come along. Oye, Didi, mami, vea, I need somebody to help me because you know. It's got to deal with my house. I know Didi. Oh, I need somebody to change a fan. Didi's going to know somebody, right? So it's the same thing as in right now. I can guarantee you, if you put on your social media, hey guys, if you're looking to buy your first Airbnb property, I have a list. Contact me. Create the opportunity. I'm pretty sure you guys know somebody in your market selling an Airbnb. And it doesn't have to be on the market. You could just buy a regular house and put it on Airbnb. The thing is, you're installing a seed in somebody's mind and saying, Didi knows something that I don't know on Airbnb properties. I might know how to make the money. I might be a surgeon. I might be a lawyer. I might be an accountant, but I don't know nothing about real estate. But I saw today on social media Didi talking about Airbnb, and it just so happens that me and my family were talking about buying an Airbnb. And here goes Didi with a little seed, and now I'm reaching out to Didi and buying a $500,000 house because I'm a doctor. I have the money. I have the resources. The only thing I don't have is inventory, which that's what you guys have. On your FMLS, you have a boatload of properties. Any property that's move-in ready is a candidate for short-term rentals. And not even that. Guys, co-living is a hot topic. Co-living is brutal. It is another way of like right now we're doing have you guys heard of RALs? RALs? Residential assisted living? Guys, otro nivel, and it has to do with real estate and healthcare. We're getting creative with the things, guys. The thing is, if you're not in that space, you're not going to know. What does RAL stand for? Residential assisted living. We're going into this boom right now. There's about 10,000 people a day turning 65 years old, and they can't take care of themselves. So, for instance, as busy as Josh and Rebecca are, life happens. I'm busy. Diddy, you're busy. Now imagine you having to take care of your parents, or because we have a big Hispanic family. So we have tias and tios, uncles and aunts that they need help too. And just because they're not my mom and dad, I'm helping mis tias and tios, right? But so what happens is you could rent out a room to house an elderly person that gets paid by Medicare, Medicaid, private pay, or private care. Otro nivel, guys. This is another level of using a house, using real estate that you guys have access to information, FMLS, all of that to create opportunities. So you have the inventory, you have the resources, now you have financing to get these opportunities out there. Your job as realtors is to promote the services that you have access to. And the biggest service you have is inventory of real estate. Any information, guys? I know we're almost at the top of the hour here. I know your time is very valuable. This is awesome information for you guys to go ahead and put this in your toolbox, utilize it, it pays very well, guys. A lot of these properties are already at market value. And on top of that, just throwing it out there, we are truly private hard money loan lenders. You guys know that your traditional lender cannot give you a referral for anything. We're private. I'm more than happy to pay out. You guys bring me a deal. If we close, hey, todos comemos. Vamos a comer lechón. Yes, guys. So, any questions? I'm gonna go ahead, open up the mics if you guys have the power to. I want to answer answering questions here. Let's see what we got here.
I have a
Joseph,
bunch.
oh, go ahead.
Oh, no. Go ahead, because I had like 5. I
Okay,
work with
do you
private.
service? Let's all talk at once like a party. Right, Joseph, do you service New Jersey?
Absolutely. Yes.
Perfect.
We service
Perfect.
Jersey. We service we service New York, Jersey, Pennsylvania, the northern states, all the way up to New York. Fix and flips nationwide. Let me see what else. Airbnb in certain parts of New York, they don't allow it, so just got to be mindful of that.
Okay, so Florida all the way, I would say Florida all the way to New York, give or take. Yeah,
Correct.
perfect.
Yes.
Okay, I have a few questions by experience too. First, I only work with investors, so I'm very familiar with the terms. Number one, I just closed a deal with a triplex, and that was in mixed use a land, which will require another kind of loan, but we were able to close somehow. Question for you: Do you do you do you do these kind of deals or you don't? When it's a
Commercial?
mix, it's not commercial because the property was on residential with the previous owner, but then now the land is transitioned to mixed use. It's not commercial.
Yeah. So
And that
that's
happened
tricky,
a
right?
lot here. Yeah, it happened a
Yeah.
lot
So
here.
so so that's tricky. Can it be done? Absolutely. That's not a problem. The thing is, the process is going to take a lot longer because the asset is used for residential, but if the zoning is for something else, then we need to catch that at the beginning so we know how to move accordingly. Now, mixed use could be apartments up top and a bodega at the bottom, right?
Yeah,
So it
that's
could
two
be,
buildings. Yeah, that
yeah,
was two
uh-huh.
buildings.
Yeah, yeah.
So I get
Right.
it. So question number 2, you say international cannot, they need a social security like regular loan, DSCR, usually is $1 more than rentals. I got a calculation. How much is, you don't do international, you say DSCR, right? You don't do international, just them. So I have investors who are bringing money here and they buy usually for DSCR. You don't do that, right? You
So
only
they
do,
they have to they have to have a green card.
okay,
They have
perfect.
to have a green card. They have to have an established LLC here
Mm-hmm.
with a bank account. And
Mm-hmm.
normally 10 out of 10 times they have that. Yes.
Yeah. Okay.
Uh-huh.
Question. Yeah, no, I have a new investors coming, so that's why I'm asking you. How much is the max percentage I can request to the seller be paid with your DSCR? 3, 6%?
You mean commissions?
No, how much in your favor? Let's say I want my buyer buy a triple fourplex and I ask him for 5% or 6% closing costs plus points, blah blah blah.
You could that's something that the seller and buyer negotiates between them. That's not a problem with us. Yeah. At the end of the day, we're gonna
But DSCR
finance
have
what.
a limit. DSCR has
Okay,
a
so maybe
percentage you
so
can
maybe
go.
I'm not you mean a seller carryback?
No, I mean
Because
how
it's
much on
different.
credit.
Credit?
Okay. Usually you put it, buyer and seller agree that seller
Mhm.
will pay closing costs for such a of amount, 3%, 6%, depends of the loan.
Yes.
The
Uh-huh.
SCR has usually 3% limit, but because you're private, I don't know how much is your limit.
Right. So that would be a seller carryback. If that's what they're referring to. Everybody's different, right? Everybody has a different term or a different way. Closing costs are closing costs, right? Or a concession. You see, like closing costs and concessions are two different things, but people tend to compare it as the same thing, right? So it all depends. Now, um, some lenders will do up to 10% seller carryback, meaning that that they will have a second lien at some sort of level that the lender's like, that's fine. As long as very minimum, we're okay with that. And that would be a second lien, would means that we will close the first closing and then they would add a second lien for less than 10% of the purchase price.
Got it. My last question, I promise. I have
No,
had
no, no. I
three.
love the questions. I love the questions.
I had three Airbnb coming to the market from one of my investors. How much will be, do you guys consider the management fee payment as part of expensive as well to do the calculation for the loan purpose?
Okay. So to qualify, I'll be honest with you. I would rather just say, hey, this is going to be ran by the owner. Okay. Because if not, then I mean your typical co-host is probably going to charge you anywhere between 18 to 25% of your gross. Y ahí se le va todo. Like all of you, like that's a huge chunk of your proceeds, right? So if you're looking to purchase or do a refinance, I advise their client to say, hey, no, we're gonna owner operate it for now. Once you close, you could do whatever you want. But you want to qualify for the loan. That's how you get to the bread and butter of this. If you can't qualify for the loan, then you're stuck, right? Now, you're not doing anything fraudulent. No, you're not. Because once you close, who's to say you actually want to manage it yourself? Or 2 or 3 months down the line, you're like, hey, listen, you know what? Maybe this was too much for me. I'm gonna let my good friend manage it for me. Who cares? It doesn't matter. It's not fraudulent at all. The only fraudulent when it comes to fraudulent is you falsifying documents or you living in the property when clearly you signed a document that said you're not supposed to. Nana, these are good questions. I love it.
And
Where are you
the
located?
last comment, I'm in
No,
Florida.
no, keep
The
going.
last The last
Keep
comment
going.
was
I love it.
in one of my DSCR, we have to adjust the down payment, which was, I think, 20% at the moment, and we adjusted to 25 because the rent rager, right? So we bought more points and then we make it qualify. That's something you can do in your loans too.
We could, but we're gonna have to run the numbers to see if it actually makes sense. Why? When you're buying points, you're buying points up front for the whole year or so, maybe a little bit more. The biggest question is asking your client, hey, are you really looking to hold on to this for 30 years?
Well,
There's a
depends on
strategy
the
to it.
property. It depends
Right.
because we bought it because the property was for the for long term for short term rental with the DSCR based on rent, which actually the price was wrong anyway. And then we make that move, but that was because we know what we're doing in the and the owner the buyer already has 7 properties in the same neighborhood. So we knew what we're doing, but we're doing as a long-term rental. We make this adjustment. That's why I'm asking, I get it what you say, oh, we have to think about the number, but I do that homework in the front. I don't do it on the end at time when we close it. I don't do that
Good.
part.
The only reason I say it out loud is because you have colleagues on this training that they don't understand that. So I know you understand you do your own due diligence up front, but many that are listening in this training, they're like, I want to be Narda, but I don't understand what they're talking about, right? So sometimes when you're buying down the interest, you're paying it with points up front, guys, right? So each point is 1% of the loan. So if you're buying $1 million home and you buy down 1%, that's $10,000 day of closing on top of everything else, right? Now you're gonna take that $10,000 and you're gonna say, if I don't pay the $10,000, how much more interest am I paying a month for months or years to reach that $10,000? Does it make sense? Does it make sense paying it now? Or I could pay that in some sort of future. But if I'm holding it for 30 years and that's my strategy, then it might make sense to pay the $10,000 now versus a half a point for 30 years. Because a half a point on 30 years on $1 million loan, it adds up, right? So everything is strategy. And then, so when we sit down with your clients, or guys, let's call it what it is. You guys too. You guys want to invest. You guys are resourceful. We're going to sit down and come up with a game plan and say, hey, Narda, I know you invest in Central Orlando, let's just say, and you want to do this for the rest of your life and maybe put this property in a trust and leave it over for your family or whatever. Cool. Yeah, we could do this strategy. But let's just say you say, you know what? My kids are not going to care about these rentals. My kids, once I die, they're going to sell this because they want to be TikTok influencers and they could care less about real estate. Then yeah, then we're gonna shift that fixed rate maybe to an adjustable. So it all depends on what strategy you or your client are aiming for, and we'll just go that way. We always give you different scenarios, and you pick and choose how you want to, navigate through that.
Amazing.
All right, let's go back here through. No, no, it was good, good questions here. Let's see here. Barbara, hello from Albany, New York. Oh my God, tell me you're a Buffalo Bills fan, because I'm a Bills fan, and we won yesterday. Oh man, that was an amazing game yesterday.
Sorry,
Uh,
no.
oh, you're
I don't
not?
follow sports, so no.
Okay.
So it doesn't count anyway.
Well, welcome on, welcome on. Let me see. Yeah, Josh, you watched The Big Short. Yep, good. Um, do you do VA loans? We do loans in traditional loans in Georgia and in Texas for now. Traditional, nothing nationwide, but VA loans, yes. Joint venture, yes, guys. Even you guys as realtors, you could joint venture with your client, create an opportunity. Tell your client, hey, listen, I'll bring the deals, you bring the down payment, and we'll work it both together. Create it. Create the opportunity. Short-term rentals, Airbnbs, Section 8, co-living. You guys are sitting on a gold mine, and that is that you have access to information. Let me see here. Can you explain the arm rate? Does it stay steady for 7 years? And on the 7 years, you don't refi or sells, does it adjust once? Okay, that's a great question. Uh, Angelina, where are you? Are you still on? Angelina Jaramillo. All right, so the arms is very simple. So let's say you're fixed for the first 7 years, and then that seventh year comes. So wherever you're at that 7 years, that's going to be your next interest rate for that 1 year. Okay. There is something called a ceiling and something called a floor. We cannot go above that ceiling and we cannot go sub that floor. Okay. So for instance, that magic number is 2 right now. So if your interest rate is 7%, the floor and ground and the floor and ceiling is 2%. That means they cannot go higher than 2 points or lower than 2 points. So if you're at 7, tomorrow is year 7, and the new interest rate is 12%, then the highest we could charge you is adding 2 points to that 7, which would be 9. So I can't be at 12% no more because I have a ceiling. So then your new interest rate is going to be 9% versus 12 because you're saved on that ceiling. Now, let's flip the script on that. If the new interest rate is 3% like it was in 2021 and you're at 7, I could only go 2 points low because I have a floor. And that floor to you would be 5%. So every year it fluctuates. Okay, great question. Ta, 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 ta. All right. All right. So Josh said Dun and Bradshaw. No, it's Duns and Bradstreet. So it would be DNB, Mastermind.com and go in there and get your free number. Your CPA or your CPA, your accountant, will charge you for this because this is a service. This is it's just like you going to sunbiz.gov or .org and creating your own LLC, which you can. It'll probably cost you maybe 100 or 200 bucks. But if you go to a professional and get your articles, your operating agreement, your EIN, your Duns and Bradstreet, that probably could run you anywhere between $1,000 and $2,000, which that's fair numbers, but that's a professional doing it for you. If you do it for yourself, you could do it. You could go on YouTube, you could do rocketlawyer.com and all that, but the reason why you're paying for a service is because it's how convenient that time is and precious is for you. Imagine you trying to assemble a motor on your car. You could do it for free on social media and try to find out and in the videos, but that could take countless of hours and stress but if you have a professional do it, they'll do it in a heartbeat. Okay, so your Duns and Bradstreet, that's all your information right there. Perfect. Barbara, you're awesome. You put it right there. Thank you. If property is vacant or under renovation at the time when market rent rate is acceptable? Barbara Perez, wow, amazing question. So, as soon as the appraisal is conducted, they'll do two evaluations. One is the as is value, and two is a 1007 report, which is your market rent analysis. And at that time, they're going to take that market rent, and that's what we're going to honor to do your DSCR ratio. Good question.
Awesome. Thank you.
Sure. Uh, what about if I'm collecting 82 and I want to refi? Okay, perfect. So, Angelina, so you're gonna take the same 8,200, right? You're gonna take 8,200, right? You're gonna take 8,200 and you're gonna divide it by into 1.2%. And so if I'm collecting 8,200, the max loan amount to let you borrow on that is $683,033, whatever it is. So you're always going to take your market rent and divide it by 1.2. We could do the 1.0 ratio. That's not a problem, but your leverage drops, meaning your loan amount drops as well. Senior niche, yep, that's it. Didi, I hope you loved it. Awesome. Ben, yep, that's a carryback. Yep. They don't have confirming loan limits. Yep. Yeah, it was a snowy game. Oh yeah. Yeah, yesterday I was at the edge of my couch just watching the Bills getting slaughtered and I'm like, "Oh my God." But yes, it was an amazing game yesterday. Um yes, joint ventures is an amazing opportunity, guys. Don't miss out. For those still on here, create your opportunities, guys. When you create your opportunities, the most important thing to do is do your due diligence on every part of your process. And that part, and one of those parts is who you're going to partner with. Not everybody's a good partner. Remember that. All right, guys. Rebecca, thank you very much for having me on today. I really appreciate it. We have other trainings that we could go over. It's a lot when it comes to investing. It's a huge topic. Everybody loves it. So whenever you guys have a slot open for me, I would love to take the
Oh my
opportunity and
God,
share
thank you.
whatever
Yes,
we
no,
can.
thank you. Thank you so much. You brought us so much value. This was an incredible session. And please, in the chat, show him some love because the truth is, we had him before. He was amazing and he definitely taught us some things. I love that you broke it down so simple for us to understand. So, and you taught us about RALs, which I hadn't even heard about yet. So, super excited about that. We need to be looking into all these niches, right? And these are opportunities where if not a lot of people are talking about it, you could be that person talking about it and just dive in and be that source of information. It could be something that can yield you something very great for 2026. So thank you for sharing these ideas with us. us. It was amazing, and we definitely look forward to having you back. We went past the hour, and I'm not even hating. I was like, let them go. Let them go, because this was amazing. So thank you all, family. We will be back here again next Monday at 12 p.m. Eastern Standard Time. And until then, have an amazing, powerful week. Thank you, Joseph.
Happy holidays, guys, and happy New Year. Be
Thank you,
blessed, and we'll see you in
Joseph.
the
Rebecca, thank you.